Am I buying Rivian stock? Rivian stock is down close to 80% since its IPO about a year ago. It is backed by Amazon and it is considered a potential rival of Tesla. But does it have potential to be a good investment, or it is more in the camp of a loser stock, which will sabotage the future returns to an investor? Stay tuned to find out all of the most valuable information about the company. As always said with educational purposes, and it is not meant to be taken as financial advice. Rivian Automotive was founded in 2009. The company designs, develops, and manufactures and sells electric vehicles and accessories. The company offers 5-passenger pickup trucks and sports utility vehicles, and Amazon owns 18% of the company, while Ford Motors owns 11.4% of the company. Let's now start with their latest results as of November of 2022. Since the start of production in late 2021 until today, the company has produced and delivered around 15,000 vehicles. In the third quarter of 2022, it produced 7,363 vehicles and delivered about 6.5k of them. Just for comparison, in the third quarter of 2022, Tesla delivered 350,000 vehicles. Make sure to watch my full upcoming analysis on Tesla here on the channel, where I delve deeper into it. For now, Rivian has 2 vehicles in production, the R1T and the R1S, a pickup truck and an SUV. Since July of 2022, Rivian has delivered its first vans to Amazon, and they now have delivered over 5 million packages to customers in the US. The company is planning by 2024 to produce more vehicles of these types. Those could include a smaller pickup using the R2T name and a smaller R2S SUV. As of November, Rivian has a backlog of 114,000 vehicles, and this does not include the 100,000 vans that Amazon has pre-ordered from them. What is a good thing for the company and speaks well about the product is that they have not spent nothing on marketing and customer acquisitions. All comes organic. Let's now discuss why the business is uninvestable for me at this moment. Rivian generated $536 million of revenue, primarily driven by the vehicles delivered in the quarter, while at the same time they generated a negative gross profit of $917 million in the third quarter. So their gross profit losses are twice the size of their revenue, meaning the business is still in its infancy when it comes to positive net income, as the net income is far away in the distant future. When a business does not generate income, it is still called an unproven business, as the business needs external funds in order to operate. These external funds can come in one of 2 ways. The first way is to increase their debt burden, and the other scenario is to issue more shares, which dilutes the current shareholders, and thus shareholder capital is getting destroyed. These factors increase the risk quite a lot for me personally. Also, the company stated in their most recent report that they see ongoing losses in the near term, which basically means we still do not know when or if we're going to be profitable. The real net loss is even bigger, and it stands now at $1.7 billion, which is close to 50% more in comparison to last year's third quarter, when losses amounted to $1.2 billion. Something I really do not like is the fact that the company is now giving away massive stock compensation packages to management in times when the business is losing crazy money and has a big potential of failure. A $135 million increase in stock-based compensation expenses in the third quarter of 2022 is absolutely astonishing for me. As a general outlook for the end of 2022, the company said it is still on track to deliver 25,000 vehicles for this year, and they expect total losses to amount to about 5.5 billion for the year. Rivian is expected to make a strategic partnership with Mercedes-Benz, which will potentially increase their revenue and drive costs down. But as they said, nothing is certain for now regarding the finalization of this agreement. As investors, we must always be conservative, and in the case of Rivian, the risks are too many for me. But let's now make a fundamental analysis of the company to see how it fares up from the perspective of its debt management, company efficiency and valuation. Regarding the debt levels, Rivian has 19 billion in total assets, while at the same time the total liabilities are only about 3.7 billion. This gives them a total equity of 15.3 billion. For now, all looks good when it comes to debt management, as the equity is 13.2 billion and a predominant majority of this equity is in cash and cash equivalents. But this cash amount gives the company only a 2.5-year burn rate if they continue to lose money at the pace of 5.5 billion a year. If the company did not lose money, I would say they're in pretty good position. But now I just do not see it. The current market capitalization of the company is 25 billion and it was 120 billion, which is very insane to me how the market could allow such a valuation when the company is a losing machine at the moment. Just for comparison, Volkswagen, the owner of brands like Lamborghini, Bugatti, Audi, Ducati, Bentley and many more, has a market value of about 80 billion. Rivian does not have a PE ratio as it does not have any earnings, so another way we can potentially value it is with analyzing the PB ratio, which stands for price to book value. Book value is a synonym of equity. For this, we divide the market cap of 25 billion by the equity of about 15.3 billion. This gives us a PB ratio of 1.63. On first glance, this is okay-ish, as below a 3 on this metric is considered not too overvalued for an auto business. But Rivian is constantly losing money, as I said, and their equity will continue most probably to fall from here. Even if the PB ratio is at 1 or below, I would not be a buyer, as my opinion is that the capital will diminish and it will not stay at these levels. A PB ratio of 1 means that the potential market cap of the company is equal to its equity, which means we're buying the whole company basically for free. A PB below 1 means we're getting more equity than what we pay for the company. In general, this is called a cigar butt approach, and it was developed by Benjamin Graham, the mentor of Warren Buffett, buying companies which are selling below their liquidation values. But this method does not work if the company is losing money. When it comes to business efficiency, I like to look at the ROIC and ROE metrics, and for Rivian, they both are in deeply negative territory. This means that their efficiency levels are negative. The ROIC is minus 150 and the ROE is minus 39. This means the company is not efficient in any way, shape or form, and this is happening due to them losing money. In general, I would continue checking the company in the upcoming future, but a lot of things need to change in order for me to look at it as a potential investment opportunity. For now, it is a pass for me as a true value investor. Check out my other video analysis on the channel and subscribe if you're interested in more similar content. Take care for now, and I'll see you next time.